Would you hire a money manager that manages your wealth on false assumptions? It seems like a bad idea, but many people unknowingly opt for such a management style in their retirement plans. Target maturity funds are one of the fastest growing mutual fund sectors of the last decade. These passive strategies are most popular in 401k and other retirement plans with limited options and long investment time horizons. Wall Street nicknames them set M and forget M funds because their strategy purportedly adjusts risk lower as you age. At first blush, such a strategy makes sense as risk tolerance is often a function of age. However, the purveyors of these funds fail to disclose that measuring risk is a function of the prices and valuations of assets. Changing asset allocations based solely on the calendar is playing roulette with your financial well-being. Target funds are passive mutual funds run by basic algorithms. The funds slowly allocate away from stocks and toward bonds based on a target future date. For example, a fund with a 2050 target date will initially invest heavily in stocks, with the remainder in fixed income assets. As the fund ages, it reduces equity exposure, leaning more toward fixed income. Target date funds are based on one simple thesis: as we age, we should reduce financial risks. There is sound logic to lessening financial risk as you age. First, there are fewer years of future income and investment gains to make up for potential investment losses with each passing day. Second, for those entering or already in retirement, the stability of wealth to cover current and future living expense is critical. Target funds fail in their complete lack of consideration for measuring risk. Equities, for example, are inherently riskier when fundamental valuations are above average and recent performance has been strong. Conversely, they are less risky at low valuations with beaten-down share prices. Unfortunately, for us mere mortals, with 10 to 30-year investing time frames matter. The start and end dates of your investment time horizon matter greatly. Blindly allocating to equities based on age and failing to account for market risks is a recipe for failure. Quite often we hear investors state the future is unpredictable. Accordingly, they claim equities offer much better historical returns than bonds. As such, why not roll the dice on history and go all in on equities? No one can tell you with any certainty what stocks will do tomorrow or next month. However, looking further into the future, market returns become easier to forecast. Based upon the current trend, stock returns become increasingly dependent on valuations as the investment horizon increases. In almost all cases, aversion to risk should increase with age. The problem is that target funds do not assess risk, just your supposed tolerance to risk. There have been multiple times in history when valuations and prior returns were well above average. At these times, a 30-year-old with a passive equity-based strategy should have reduced their equity exposure. Conversely, there are times in history when prices and valuations were so beaten down that a 70-year-old should have had high exposure to equities. We picked on equities in this video, but the same logic applies equally to bonds and most other asset classes. Today, valuations stand at extreme highs. We should expect annualized equity returns of 0 or even below 0 based on the regression of historical returns and valuations. If your wealth is actively managed, current high exposure to equities is fine. The advice assumes you or your manager is aware of the risks and ready to act if necessary. Most 401ks offer their participants many alternatives alongside target funds. For those that elect to take passive strategies, like target funds, I would strongly advise that you assess your risk profile and that of the markets and invest accordingly. We all know that this current financial market is extremely hot right now and someday things have to cool off. When they finally cool off, there might be a correction like we have never seen in recent history. If there was another scary correction like in times past, then you can rest assured that all stocks, regardless of what fund you are invested in, will be wiped out. We are living in financially uncertain times. So invest wisely, my friends, and make sure you have real tangible assets just in case your retirement plans don't work out as planned. Thanks for watching this video, and make sure to leave a comment below to let me know if you have been rethinking retirement lately. Subscribe if you are new to the channel, and I will see you on the next video.